So good evening, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sise, your tutor and your mentor. So basically, today we are going to, based on our agreement, we are going to do some recap on the various accounting standards that we covered in the previous live session. That is IAS 16, IAS 40, and IAS 38. So basically, let me share my screen. So are you guys seeing my screen, right?
Yes, sir.
Very good. So basically, when we are talking about um, tangible non-current assets, we are going to look at various accounting standards that we are going to cover for the examination. But today, we are just going to focus on IAS 16, which is property, plant, and equipment. And also, we are going to browse through the key areas for the examination as um, based on my expectation, the recording session, everyone should have covered the various standard that we need to complete for today and in our next session. Because the exam is just around the corner. We barely have 2 months for the examination. So we need to press and we need to see how best we can complete the syllabus within the 2 months period. So today we are just going to browse through the key points for IAS 16 and nothing to worry about. We are going to look at depreciation, how we can depreciate assets, and also the revaluation. More important about the evaluation is how to account for the gain on evaluation or the loss on evaluation. And also, in our further session, we're going to look at borrowing costs and government grants, but no need to worry about that for today. So now, you need to know the definition of property, plant, and equipment. I'm not going to spend too much time on the definition, and I just want to browse through the scope. A tangible asset held for use in production or supply of goods or services or rental or for administrative purpose. Expected to be greater than 1 year period. Now, we are not going to include biological assets, investment property, as we are going to cover them under IAS 40, and also the non-current assets held for sale and discontinued operation, which is the IFRS 5. So we don't need to worry about it. Now, the critical part about property, plant, and equipment is the recognition criteria. You need to know your recognition criteria, and also you need to match your recognition criteria in line with the conceptual framework. I've discussed that in our previous session. So basically, when we are talking about the recognition criteria, there are two key recognition criteria minus the definition of the asset. These two conditions should be met if you want to recognize. And when we are talking about recognition, it means we need to include a transaction into the financial statements. So for us to include any transaction that we can classify as IAS 16, these conditions should be met. First condition, it is probable that the future economic benefits associated with assets will flow to the entity. Now, what the probability is saying, it should be greater than 50% chance that we can receive the potential economic benefits from the asset. Now, for example, we want to purchase a machine that we are going to use to improve on our production capacity. Currently, our production capacity, we can produce 10,000 bottles of pure water, for example. But based on the demand and the current economic environment, the demand has increased significantly. So we want to increase our production capacity. So we decided to purchase a new machine that we can use to improve our production capacity from 10,000 bottles of water to 15,000 bottles of water. So now, if we decided to purchase that particular machine, then if the machine can give us the required production capacity of 15,000, it means the economic benefit from that particular machine is 15,000. So for us to recognize the machine in our financial statement, we should have greater than 50% chance that we can achieve the 15,000 production quantity of bottled water. That greater than 50% chance should always exist before we are going to consider whether we should recognize this transaction or not. So the probability of the future economic benefits should greater than 50%. You need to note it down, which is very important point for the examination. First point you need to note. The second point, the cost, we need to measure the cost reliably. When we are talking about the cost, for example, if you want to purchase the machine, it is obviously clear that you will request for three quotation. There should be a cost associated with the machine. So that reliableness of the cost is what we can classify as the measurement criteria. So these two conditions should be met. Firstly, there should be greater than 50% chance that the economic benefits can be achieved from X, Y, and Z transaction. Then also we can able to measure, we can able to assert, we can able to calculate the cost associated with that particular transaction. That's why when we are going to look at intangible assets, the internally generated intangible assets, we are not going to capitalize it because the cost cannot be measured separately from the rest of the business. But don't worry about it, we are going to look at it. So these two conditions, you need to know these conditions before you're going to understand anything further from IAS 16. So now the measurement criteria, we have two. We have the initial measurement and we have the subsequent measurement. For the initial measurement, all property, plant, and equipment initially should be measured at cost. When we are talking about initial measurement, it means on the transaction date, the first measurement that we are going to use to include a transaction in the financial statement is what we mean by initial measurement. So first initial measurement, we have to consider all associated costs directly linked with that particular transaction, whether it's the purchase cost, whether it's the installation cost, whether the transportation cost, any cost that is associated with that particular asset, we can include it as part of the cost of the asset. Also, if we are going to look at IAS 23, the borrowing cost, for example, if the company decided to secure loan to support the purchase of X, Y, and Z machine, that loan that we are going to secure based on IAS 23 borrowing cost, it has its own condition. We are going to look at it separately. But the interest that we are going to pay on that loan should be capitalized as part of the cost of the asset, which is very important for you to know. We are going to look at borrowing costs separately. But for this session, borrowing cost as per IAS 23, the interest that I'm not talking about the principal amount that we are going to take out from the loan or the loan amount, but the interest that we are going to pay on that loan should be capitalized as part of the cost of the asset. And also, items that we are not going to capitalize, for example, for the installation of the machine, we need to train X, Y, and Z employee to continue to maintain and run the machine, for example. Those training costs, we are not going to include it because it is not directly linked with the purchase and also to ensure the asset is at its current working condition. Then finally, which is more important, the dismantle cost. We are going to look at the concept of dismantle cost. I've explained it in the previous section as well. So I'm not going to spend more time. I'm just going to solve this example on the dismantle cost so we can able to understand it better. So basically, the concept of dismantle cost is saying that, for example, if we are going to, are you seeing my screen right?
Yes, sir. Yes, sir.
Very good. So now, for example, let's assume we want to install or want to build a fuel station in a specific location, for example. Now, based on the environmental impacts of the fuel station, we need to dig so that we can have enough space to keep the fuel that we are going to sell to our customers. So if that is the case, we need to change the structure of the environment of the community. We need to dig, we need to make bunkers, and we need to set some other structures. Let's assume we have an agreement with the community that in 10 years' time, we need to dismantle, we need to remove the fuel station from the community, and we are going to hand over the community back, the land to the community, which is clear. So now the concept of dismantle cost is telling us that based on the agreement with the community, we need to pay amount in the future. But as of the concept today, we need to calculate the present value of this future payment that we are going to pay. So this is the concept of dismantle cost. That's why we are going to discount the future cost to its present value. So now let's solve this question so we can be able to understand better, right? The requirement, calculate the cost of assets, depreciation, and how the liability is treated. So basically, we are going to look at the amount that we are going to include as part of the assets and also the liability, how we are going to account for the liability. Now, the question one, construction cost, 8 million. Site preparation cost, 2 million. So solution, cost of assets. Hope you guys have calculator, right? The construction cost. The construction cost is 8 million, right? The site preparation. Are we together?
Yes, sir. Yes, sir.
Yes.
The site preparation
Yes,
is 2
sir.
million. And the installation is 4 million. Also, based on the environmental impact, it is required to dismantle or remove the assets in 10 years' time at a cost of 4 million. Interest rate is 5%. So now from the question is telling us that at the end, based on the environmental impact, at the end of year 10, we need to dismantle, we need to remove the building, we need to remove the construction, the site preparation, the installation, everything that we are going to install, we need to remove it from the environment. So the cost that we are going to spend in the next 10 years will be 4 million. So we are going to spend 4 million in year 10, not as of today. So now we need to know what is the present value of this 4 million in 10 years' time, because the 4 million is the future value. That is the amount that we are going to pay at the end of year 10. So now what we need to know what is the present value as of today, as of the date of transaction, as of the date we are going to account for this particular construction site preparation. We need to know what is the cost that we are going to account for in our financial statement. So because of this, we are going to use the concept of the discount factor. From the notes, you can see the formula to calculate the discount factor. The discount factor is what we are going to use to calculate the present value. We are going to apply the discount factor to the future value so that we can get the present value. So basically, the present value, the present value is equals to the discount factor multiplied by the future value. Are we together? So this is the formula to calculate the present value. So now the discount factor, you can look from the note. It is 1 divided by 1 plus r raised to the power n. So this is the formula for the discount factor, which is in bracket 1 divided in bracket 1 plus r bracket close raised to the power n raised to the power n. The r is the interest rate. We are going to deal with it separately. The n is the number of years. So this is how we are going to calculate our discount factor. So basically, the discount factor calculation will be 1 divided in bracket 1 plus r, which is 5%. So I can say 1 plus 5%, bracket close, raised to the power 10, because we want a discount factor for 10 years' time. Multiply by the future value of 4 million. Are we together? Hello?
Yes. Yes, sir.
So
Yes,
let's
sir.
calculate
Yes,
the discount
sir.
factor. Let's calculate the discount factor. Let's deal with the denominator first. 1 plus 5%, it will be 1.05%, 1.05 raised to the power 10. What is the answer? 1.05 raised to the power 10. 1.05 raised to the power 10.
I'm having 1.629 3 rounded to 3.
So
Digit.
you can leave it like that. So you can use your calculator. 1 divided by answer. 1 divided by answer. One divided by answer.
0.61 4
0.61 to 4 decimal place.
39.
61439. So 44, right?
So let others check. I might be wrong or not.
Jennifer,
Yes, sir. Yes, 0.6139.
39, 0.639, right? Okay.
Yeah.
Multiply by 4 million. Multiply by 4. We are going to multiply by 4. What is the answer?
2455.8.
2
2.456.
2.456.
455. Okay, round
6.
up. Okay, 6. Okay.
Okay. So basically, the 2.456 is the present value of 4 million. So it means when we are going to account for this transaction as of today, we are going to account for it as 4.56. So it means the present value of 4 million in 10 years' time, as of now is 2.5 and 2.456. So now, according to IAS 16, the dismantle cost, the present value of the future payments, we are going to treat it in twofold. Now, this is the double entry or the accounting treatment of dismantle cost, right? So we are going to debit the assets. We need to capitalize the asset and we are going to credit the liability. Now, why are we going to debit assets and why are we going to credit the liability? Because the dismantle component is the cost that we are going to pay in 10 years' time. So we need to bring it to present value. It is part of the cost that we are going to incur, and also that cost will provide the economic benefit for the business, because if the community did not give us the access to install whatever property we want to install in the environment, then it means we can't able to operate, we can't able to achieve our economic benefits. So the dismantle cost is part and process of achieving the economic benefits as per the definition of the asset and as per the conceptual framework. So if the dismantle cost is part of the component of the construction progress, then it means we need to include that particular dismantle cost as part of the cost of the asset. Now, why are we going to credit liability? Which is very much important, because if we are going to look at the definition of liability, there should be a present obligation as a result of past events which can result to outflow of economic benefits. Now, there is a present obligation because based on the agreement with the community, we need to dismantle this construction in year 10, which is very clear. We have an obligation. If we did not comply with that obligation, then the community can take us to court. They can take legal action against us, which will disturb or which will destroy the reputation of the business. So there is a present and existing obligation. It should result to outflow of economic benefits, which is clear. In year 10, we are going to pay $4 million, which can result to outflow of economic benefit. That we are going to spend that particular money. And it's as a result of past events based on the agreement with the community. So all the three conditions as per the definitions are met. So we are going to recognize a liability. So now we are going to debit the assets with 2.456 and we are going to credit the liability with 2.456. Simple. So now, how are we going to continue the subsequent recognition of the assets and the liability? Is very much important for the examination. You need to understand that aspect. So for the asset, what we need to know, we need we need to depreciate the asset, whichever depreciation condition, whether straight line or reduce imbalance. whichever method we are going to use to calculate our depreciation, there is nothing to worry about it. So we need to depreciate the asset. So now what we are going to do, we need to include the cost of the asset, installation cost or dismantle cost as part of the cost of the asset. Dismantle cost, which is 2.456. So the total cost of the asset, total cost will equals to 8.8 plus 2, 10, 4, 14, it will be 16.456, right? So this is the total cost of the asset. Are we together?
Yes, sir.
Yes, sir. Yes, sir.
Very good. This is the total cost of the asset. So now when we are going to depreciate, we are going to depreciate the total cost of the asset. So we are going to depreciate the 16.456 over the 10-year period. Are we together?
Yes, sir.
Very good. So
Yes,
what
sir.
so what I want you to understand is that the dismantle element, we are going to include it as part of the cost. Then we are going to depreciate it as normal. Nothing else, nothing difficult about it. Now, we are going to look at how we can account for the liability. How to account for the liability. Now, this is the technical part that you need to know and you need to understand. Now, the present value is not equals to, is not equals to the future value. The present value of 2.456 million, right, is not equals to the future value of 4 million. So where is the difference? That is the question we need to ask ourselves as a student. Where is the difference between the present value and the future value? Now the difference is as a result of time value of money. So now the concept is telling us that what we need to know, we need to ensure on annual basis, we need to unwind. So the difference precipitate the concept of unwinding. The difference between the difference precipitate the concept of unwinding. Now, the unwinding is telling us, simple concept is telling us that on annual basis, we need to increase our liability. So the unwinding is telling us that on is telling us that on annual basis, we need to increase the liability by the interest rate. So now this is the concept. On annual basis, on yearly basis, we need to increase our liability. Now, how are we going to increase our liability? To increase the liability, we need to multiply the interest rate by the closing liability. So to, to calculate the unwinding is equals to the interest rate multiplied by the closing liability. Not the opening liability, but we are going to use the closing liability. So now for year one, the unwinding, the interest rate is 5%, right? Multiply by the closing liability, which is the 2.456. Are we together?
Yes, sir.
So 5% multiplied by 2.456. 4, let me
0.1227.
mark it. 0.1227,
1228.
1228. So now, how are we going to account for this dismantle cost? It's very much important. Again, you need to know. Now, for a dismantle cost, the accounting treatment we are going to debit expenses, and we are going to credit liability. So for us to increase our liability, it means we need to credit our liability. So we are going to debit expense with 0.1228, and we are going to credit liability with 0.1228. So this is the accounting treatment that we are going to do for year one. Year one, we are going to debit expenses and we are going to credit liability. Crediting liability means we are going to increase the liability. And be guided that the concept of unwinding is for us to increase our liability. So whenever we are going to credit a liability, it means we are going to increase our liability. So this is what we are going to do for year one. We are going to do the same for year two. Year two, the unwinding cost for year two, right? Unwinding cost for year two will equals to 5% multiplied by the closing liability. Now the closing liability will be the 2.456 plus this year one liability that we have credited. We are going to include the year one liability that we have credited. At the camera, give me some more time. So now we are going to include the liability that we have credited, 0.1228. So our total liability, our closing liability will be 2.56 plus 0.128 multiplied by 5%. What is the answer? Hello guys, what is the answer?
0.1289. 0.
2.456. 2.456 plus. Sorry, this is not multiplication, this should be plus.
Yes, plus
0.22, 0.1228.
0.1289. The total times the 5%. The total I'm talking about.
Okay,
1289.
0.1285. Right? So
Eight
And
nine.
eight
also
nine.
8 9.
89.
8 9.
Okay, so
Yeah.
also we are going to do the same accounting treatment for year two, but this time around we are going to debit 0.1289 and we are going to credit 0.1289. So we are going to do the same for year three. Year three, unwinding cost, right? Equals to 5% multiplied by the closing liability. The closing liability will be 2.456 plus liability of year one, the unwinding of year one, 0.1228 plus the unwinding for year two, 0.1289. So this will give us the total liability, the closing liability for year three. Two point four five six plus 0.1228 plus 0.1289.
Is 0.1354.
Equals to
0.1354.
0.1354. So now we are going to do
Yeah.
the same. 0.1354, 0.1354. So we are going to do the same approach for year 4, year 5, year 6, year 7 to year 10. Then at the end of year 10, at the end of year 10, right? The closing liability should equals to the future value. the future value, which is 4 million. So basically, this is the concept that you need to know for the dismantle cost. So you need to look through it, you need to go over it once more. And also you're going to do for year 4, 5, 6, 7, 8, and year 10. Therefore, the closing liability that you are going to get for year 10 should equals to the 4 million, or it can be 3.999 because of the rounding error, or it can be 4.1, whichever, but it should be 4. Any question before we are going further? Any question?
Yes, sir. For objective purpose,
Okay.
uh, will they ask for the like for 9 years?
No,
Any
no, no, no,
formula?
no.
Just
No, they can only ask for
okay.
2 years. They can't ask for anything beyond 2 years
O- Okay. Okay. Because okay.
because it will be time consuming. Any other
Exactly.
question
Okay,
before
sir.
going
Thank you.
further? Laura to Jennifer. Famata.
Yes, sir.
Yes, sir.
Okay.
Um,
Let's
what about
proceed.
the additional cost on the cost, like upgrading to upgrade the machine instead of dismantling it?
Okay. So are you asking how are we going to account for the upgrading?
Oh, I'm just asking.
Okay.
Okay.
The upgrading, it depends. Now we have the concept of the subsequent expenditure. We are going to look at it in our next chapter. Now, when we are talking about subsequent
Oh,
expenditure, if the expenditure can improve or can enhance on the economic benefits of the asset, then that cost we are going to include it as part of the cost of the asset. Now, for example, as I mentioned earlier, the machine we want to buy will increase our production capacity to 15,000 units. Let's assume we have achieved that limit. But because of the increase in demand, we want to improve it to 17 or 18,000 or bottle of pure water, for example. Now we don't want to buy new machine, but we want to upgrade some features within this current machine that we are using. So now we want to buy special parts that we are going to put in the machine that will increase our production capacity. So that particular upgrade, if the upgrade can increase our production capacity from 15,000 to 15,500, 16,000, whichever quantity, we are going to include that cost as part of the cost of the asset. Whether we are going to purchase it, whether we are going to do the upgrade in year 10, year 5, it does not matter. What matters is that the economic benefit of the machine can be achieved, can be increased because of that particular upgrade. But if the cost that we are going to incur will not increase on the economic benefit, for example, we decided to do general maintenance, but yet still we are going to produce 15,000. We are not going to produce anything above 15,000. We are going to do maintenance. We want to paint the machine. We want to change the diesel, whichever situation it might be. Hence, the economic benefit cannot increase. We cannot increase the economic benefit. Then that particular cost should not be capitalized as part of the cost of the asset. Instead, we are going to expense that particular cost. So now let's go to the next chapter so we can able to get it right. Very good. Subsequent expenditure. Now, we can only include subsequent expenditure if it can enhance the economic benefits provided by the asset. Then we are going to include that particular cost as part of the cost of the asset. Very important concept. As I explained earlier, if the production capacity is 15,000 units, then if we decided to upgrade that machine, that upgrade that we are going to do on the machine to increase our production capacity from 15,000 to 20,000 to 21,000 to 15,500. We can capitalize that cost. We can include that cost as part of the cost of the asset. Then also, we have different area of component cost. For example, the airline industry, where the plane, it has different components. The engine, major components. Based on the components, they have different depreciation period based on the useful life of each component. For example, the engine, the interior, the exterior body, the aircraft component. They have different um, method of calculating depreciation. So now, if we want to change any major component, we want to replace any major component, that cost, we are going to include it as part of the cost of the asset as subsequent expenditure. Are we together?
Yes,
Yes,
sir.
sir.
Very good. So now we are going to look at this example. Nothing to worry about. You can go through the example. I don't want to waste much time. Nothing much about it. From the example one, due to the increase in demand for the production, the assets required expansion to meet increase in demand at a cost of 1.5. Because of the expansion, it can increase the demand. Then we are going to capitalize this cost as part of the cost of the assets. Another very important point we need to know, for example, if we have a, let's say, a single story building, one flat with 2 rooms and parlor, which we are used for office purpose. It will occupy, let's say, 5 employees, for example. Now, if we want to expand that particular building so that it can contain more than 5 employees, let's say 7. So if we decided to expand any part of the building to make a new office space, that cost that we are going to incur, we need to capitalize it because it will enhance the economic benefit. Before, the building will contain 5 employees. Now it can take 7, 8 employees. But if the cost that we are going to incur is just to paint, to install AC, to repair some few parts that cannot expand on the number of employees, then that particular cost, we are not going to include it as part of the cost of the asset. Instead, we are going to expense it. And when we are talking about expenses, we are going to debit expenses and we are going to credit whichever payment method, whether we are going to pay in cash, whether we are going to pay later. That is not our problem. But when we are talking about capitalize, it means we are going to include that cost as part of the cost of the asset. Simple. Now we are going to talking about subsequent measurement. So when we are talking about subsequent measurement, it means after we have completed the initial measurement for year one, after we have completed the initial measurement for year one, the subsequent measurement for year two, year three, and so on, how are we going to do that particular measurement? Is very much important for the examination. We have two options to do subsequent measurement. We can either use the cost model or we can use the evaluation model. So when we are talking about the cost model, it means we are going to calculate the cost of the assets as I've explained, and also we are going to minus any accumulated depreciation or impairment. For the evaluation, we need to evaluate the assets when there is a need for the evaluation, and also we need to know how we can account for the increase or decrease in the evaluation, which is very important for the examination. So now, in our previous section, I've covered how to account for the evaluation, but never mind. Now, when we are talking about the evaluation, we are going to look at the fair value at the evaluation date minus depreciation. If the asset value is 10 million, but the subsequent measurement, we decided to use the evaluation model. The asset value has increased from 10 million to 12 million. So that 2 million, we are going to account for it under the evaluation surplus because based on the prudence concept, we are not going to recognize again until it is realized or it is crystallized. That's the time we are going to recognize again. And the concept of fair value, the concept of evaluation is just an assumption that the asset value has increased, or based on the independent expert, the evaluator, based on the reports from the evaluator, the asset value has increased from this to this. But it is not an actual increase in asset value until we decided to sell that asset. That's the time we are going to generate the actual, income from the disposal of the assets. So now, for the loss on evaluation, we are going to include it in the expenses because according to the prudence concept, we are going to recognize a loss when there's an indication that we are going to spend that particular money. So because of the prudence concept, that's why we are going to account for the gain on revaluation under the evaluation surplus, while the loss on the evaluation, we're going to take it to the profit or loss account as expenses. So now for the depreciation, nothing new about depreciation, the same concept. We're going to depreciate the asset. We have when we're talking about depreciation, it means we want to to spread the cost of the asset over the useful life of the asset. That's what the concept of depreciation is talking about. So now the whole basis for depreciation is for us to assert based on the cost of the asset, we need to spread the cost of the asset over its useful life. So if we are going to spread the cost of the asset over its useful life, it means we have option to use the straight line method, the risk imbalance method, or the machine hour. The straight line method is simple, nothing to worry about. We are going to allocate same amount throughout the life of the asset. For reducing balance method, on annual basis, we are going to deduct the depreciation, the previous year depreciation from the current year cost to calculate our current year depreciation. So nothing to worry about it. For this example, you can go through the lecture notes, you can see it clear. I don't want to spend much time. So now evaluation of non-current assets, which is very much important for you to understand the evaluation model. Also, what you need to know in a situation where the company for subsequent measurements is using the cost model, there is no need for the company to change to evaluation model. Or if the company decided to change to evaluation model, it should not move back again to cost model. We don't want to see that you need to go through the recording session before the live session because you know I'm not I did not have the time to explain everything again on the live session because we only have 2 hours to complete 2 or 3 accounting standard per day. So you need to go through the recording session so that when we are going to browse through the live session, we are going to explain key concept that you need to move. So now basically these are the journal that you need to do for the. So basically, um, nothing much about IAS 16 again. You can solve the question on your own. And the previous section, I've solved few of the questions for the IAS 16. So what we are going to do, come again. So what we are going to do, these questions, we are going to share it on the WhatsApp group on daily basis. We are going to discuss the question. We are going to discuss the answers so that so that we can, able to get ourselves on the situation, which is very much important. So now we are going to move to IAS 40, which is investment property. Any question for IAS 16? Any question?
Okay.
So we're going to move to investment property. So now, when we are talking about investment property, what you need to know, few things. One, you need to know what are you going to classify as investment property. Two things. Firstly, if an asset or property is held for rental purpose, then we are going to account for it under investment property. For example, you're a landlord, you're going to rent your property, your house, whichever property you're going to rent out. The income, since the property is for rental purpose, then that property we can classify it as investment property. Second condition for capital appreciation. When we are talking about capital appreciation for land, you purchase a land today, currently you don't have any use of the land, you don't use the land for any purpose, you know, so automatically by default, the value of the land will change in future. If you buy the land today for 10 million, then by default, in 5 years' time, the value of the land will not be 10 million anymore. It will be 15, 20, whichever value. So that capital appreciation from the land, because of that, we are going to account for it as investment property. So this is the two conditions for investment property. Any other one, we are not going to account for it as per IAS 40. Instead, we are going to use different accounting standards. For example, if the building is used for day-to-day operational activity, we are going to use IAS 16. Or if the building or the property is held for sale, we are going to use IFRS 5, non-current assets held for sale or discontinued operation. So now, what you need to know about investment property, we have two models to measure our investment property for subsequent. The subsequent measurement, we have the cost model and we have the fair value model. Now, when we are talking about the cost model for investment property, we are going to account for it as per IAS 16, nothing to worry about. Looking at the cost of the asset and we are going to depreciate it. Simple. For the cost model, as per IAS 16, is what we are going to use to account for the investment property using the cost model. Now, for investment property under the fair value model, this is where the problem is. How are we going to account for fair value for investment property using the fair value model, which is very important for the examination? Now, three conditions that you need to know for fair value model for investment property. Firstly, we need to revalue the asset at the year end. On annual basis, we need to revalue the assets. First condition. Secondly, the gain or loss on the evaluation, we are going to treat it directly to the statement of profit or loss instead of other comprehensive income. Finally, we are not going to calculate depreciation on investment property under the fair value model. I'm not talking about the cost model. Under the fair value model, we are not going to calculate depreciation. Under the fair value model, I'm going to repeat it again. Under the fair value model, we are not going to calculate depreciation. So these three conditions, you need to know them. You need to get them back of your mind. For fair value model, on annual basis, we are going to revalue the property. The gain or loss on evaluation, we are going to take it directly to statement of profit or loss. and there is no depreciation. We are not going to calculate depreciation on the fair value. So now example one, you can solve it. I really don't want to solve example one because based on the record insertion, the solution for example one is there, so you can go through it. So what you need to know for now, I don't have anything further to analyze unless the linkages between IAS 40 and IAS 16. So now, when we are talking about the linkages, it is possible that um, an asset is currently used as per IAS 16, property, plant, and equipment, but the company has decided not to use the asset anymore for its day-to-day operational activity, but the company want to rent that property out to achieve or to gain a rental income from that property. So now it means we need to move from the IAS 16 to IAS 40. We need to move from property, plant, and equipment to investment property. So how are we going to do that particular transaction is what you need to know. If you can go through my recording session, this is detailed analysis on how you need to do the movement from IAS 16 to IAS 40 or from IAS 40 to IAS 16. But now, for this particular live session, what I'm going to tell you between the movement from IAS 16 to IAS 40 or from IAS 40 to IAS 16 is that now, if currently the asset is measured as per IAS 16, before the date of transfer to IAS 40, we need to ensure that we calculate the carrying value of the asset. In other words, we need to remove all depreciation or impairment before we are going to transfer the asset to IAS 40. Note that point down. For if the asset is maintained at using IAS 16, whether it's cost model or evaluation model, it doesn't matter. We need to calculate the carrying value of the assets before the transfer date. We need to calculate the carrying value of the assets before the transfer date. That's the key concept you need to know. Once we have calculated the carrying value of the asset before the date of transfer, then we are going to transfer that particular asset using the carrying value as investment property. Thereafter, from that date of transfer, we are going to use the concept of investment property to account for that particular asset. Simple. Alternatively, if the asset is initially maintained at IAS 40 investment property, but we want to transfer it to IAS 16, we are going to do the same thing. We are going to calculate the carrying value of the asset at the date of transfer before we are going to do the actual transfer as to investment to IAS 16. So that's what you need to know for the examination. First, for investment property, you need to know the definition. For capital appreciation, for rental purpose. Secondly, you need to know how to account for the cost model and the fair value model. The fair value model, you need to know the three conditions. First, we are going to do annual fair value evaluation. Second, the gain or loss on evaluation should be taken directly to statement of profit and loss, not other comprehensive income. Finally, we are not going to calculate depreciation on investment property under the fair value. Under the cost model for investment property, we are going to treat it as normal. We are going to depreciate the asset. We are going to impair the assets if that is the case. But for fair value, we are not going to depreciate the asset. We are not going to calculate depreciation or impairment on that particular asset because it is for capital appreciation or for rental purpose and it is measured under the fair value model. So nothing to worry about um, investment property. All that you need to know about investment property. So now we're going to move. Any question on investment property? Any question? Hello guys.
No, sir.
Any question? Chono,
No, sir. No, sir. No, sir. I'm okay.
No, sir.
Jennifer,
No, sir. I'm good.
Auntie Famata. Auntie Famata.
What question, sir?
Okay, thank you very
What
much.
question, sir?
Okay, so we are going to move to IES 38 intangible. So now basically, under the intangible, it's very important accounting standard and it is frequently tested in the examination. So you need to pay attention and you need to go through the recording session for detailed explanation. You have already used 1 hour just to browse through the key concepts. So we don't need to spend much time. And also today I want us to complete and borrowing costs at least. Then on Thursday, when we are going to do ratio analysis, we are going to do one accounting standard so that we can complete the accounting standard for this week. Probably we are going to look at government grants or we are going to look at 36. So basically, when we are talking about intangible assets, which is IAS 38, we are going to look at how we can account for research and development cost and how we can account for goodwill under IFRS 3, the business combination. So basically, nothing to worry about. We are going to look at it. It is not difficult, just that it's a little bit technical. So now, what is the definition of intangible asset? When we are talking about intangible assets, this is an asset and it is an identifiable non-monetary asset without physical substance. Intangible assets did not have any physical substance. We can't see intangible assets. For example, we are talking about brand name, we are talking about goodwill, we are talking about patent, we are talking about copyright. We can't see all of these features. Now, for example, um, let's assume the recipe. We want to start the production of Coca-Cola in Sierra Leone. So therefore, we need to purchase the recipe from Coca-Cola, whichever parts of the world. So now that cost that we are going to pay so that we can have access to use the brand name as Coca-Cola is intangible asset. Now, why are we going to account for it as intangible asset? It is because if we have the brand name to use Coca-Cola in Sierra Leone, it means it can improve on our economic benefits. It can increase our economic benefits because everyone who wants to drink Coca-Cola, the goodwill has already been established. The reputation of Coca-Cola has already been established. So you are going to pay so that you can have access to use the brand name Coca-Cola so that you can benefit from the reputation, you can benefit from the good taste, you can benefit from the customer loyalty that has been developed for quite a long period of time. So for you to achieve that economic benefit, the amount that you are going to pay should be included as intangible assets in the financial statement. You are not going to see the brand name that you are going to pay for, but you are going to receive the economic benefit from that payment that you are going to do. So this is the concept of intangible assets. So in our later session, we are going to look at why are we going to capitalize purchase intangible and why are we not going to capitalize the internally generated intangible asset. So basically, these are examples of intangible asset, license and quotas. For example, if you want to establish a telecommunication, you need to secure license. The license will give you access to set up your telecommunication. If you don't have the license, you don't have the right to operate a telecommunication. For example, Africell, Orange, QCell, they all have a telecommunication license. That license will give them the access to operate, to function as a mobile company in Sierra Leone. So that amount that they are going to pay is accounted for as intangible assets in the financial statement of Africell, Orange, or QCell. Also, we are talking about broadcast license, fishing quota, whichever the case might be, we are going to account for it as intangible assets. So now, when we are talking about intangible assets, before we are going to account for intangible assets, it should meet the definition of an asset controlled by an entity as a result of past events. Now, for example, if I want to establish a telecommunication, I'm going to pay for the license. That license will give me the right for a specific period of time. For example, the license is for 2 years. Within that 2 years, I'm going to dictate how to run X, Y, and Z facility within the network. So the license will give me the controllability factor. It will give me the right to use that particular facility, that particular license. Also, it will result to the future economic benefits as I explained initially with Coca-Cola. If I'm going to secure the brand name Coca-Cola, it means I'm going to produce Coca-Cola drink, which will improve on my economic benefit. So the definition of an asset should be met before we are going to consider whether we should account for the intangible assets in our financial statement. Don't forget, when we are going to look at the recognition criteria, it is very important to understand. Firstly, about the recognition criteria is the definition. Secondly, it should meet the criteria as per the conceptual framework, the probability of the future economic benefits, and also the cost should be measured reliably. All recognition criteria are the same for all non-current and current and tangible assets. So now, when we are talking about, I've explained under IAS 16 about the probability of the future economic benefit. There should be greater than 50% chance that we are going to receive the future benefits from the assets. For example, if we purchase the brand name from Coca-Cola, it means 50% chance that we can use the Coca-Cola name to improve on our production capacity. Also, the cost should be measured reliably, which is very much important. The license that we are going to pay, we need to measure the cost reliably. The brand name that we are going to pay for, we need to measure the cost reliably. So these are the recognition criteria for intangible assets. You need to know these recognition criteria and you need to understand these recognition criteria. Now, key part, purchase intangible assets and internally generated intangible assets. All purchase intangible assets should be recognized in the financial statement. All purchase intangible assets, we are going to recognize it. For example, we want to use the Coca-Cola, we want to pay for the brand name, we are going to account for it because we can receive the economic benefit from the Coca-Cola and also we can measure the cost reliably because we actually pay to use the brand name. Also, if you want to do advertisement, for example, you want to use the logo of Manchester United in your business, you're going to pay Manchester United to give you the rights to use the logo, for example, whichever the case might be. And the intangible asset is purchased, then we are going to include it in our financial statement. And we have two measurements, we have the cost model or we have the evaluation model. But in real life, it is difficult to use the evaluation model for intangible assets because once I've paid for the the brand name, for example, the payment can only change after the period I've made the payment for. For example, if I decided to pay for the brand name for 5 years, the payment can change after the 5 years. So there's no need for us to do the evaluation model on the intangible assets. It is not applicable in real life. Mostly, the cost model is used to calculate or to measure the intangible assets. So now all purchased intangible assets should be capitalized. And also we are going to account for it as normal. As per IAS 16, we are going to amortize it, which is the same concept for depreciation over the useful life of the asset. Nothing to worry about. We can either use the straight line or you can use the residual value. But in most cases, for intangible assets, we are going to use the straight line method to account for the, the amortization. Now, an intangible asset with indefinite useful life, key point that you need to know for the examination, and this point is frequently tested in the examination. Look at the highlighted point. For intangible assets with indefinite useful life, what you need to know when we're talking about indefinite useful life, we don't have a specific period of time for that particular license for now. You understand what I'm saying? For example, when you have qualified, you have the right to practice on annual basis, you need to pay subscription and membership fee. So the period for your membership is indefinite unless you decided to commit a crime, then they can withdraw your qualification from you. Other than that, it is indefinite. So if you want to account for it, for example, what you need to know, you should not amortize that particular intangible asset because it is indefinitely. There is no specific period of time that that particular license or brand name will come to an end. So we are not going to calculate amortization on that particular. Then secondly, on annual basis, we need to test that intangible asset for impairment on annual basis. You need to note this point down. These are the key points when you are studying, you need to focus on. For intangible assets with indefinite useful life, we are not going to amortize it. Also, we are not going to test we are going to test for impairment on annual basis. Annually, we are going to do impairment review for intangible assets with indefinite useful life. two conditions that you need to know. For intangible assets with indefinite useful life, we are not going to calculate amortization. Then on annual basis, we are going to test for impairment for any potential reduction in value of the asset. So now for the evaluation model, nothing to worry about for the evaluation model. So now we are going to look at internally generated intangible asset. For internally generated intangible assets, IAS 38 telling us that we should not include internally generated intangible asset. We should not capitalize it as part of the cost of the asset. Now, what is internally generated intangible assets? For example, I'm currently trying to develop a brand name of MSS mentorship. Now, let's assume in 5 years' time from now, I've established a solid brand name with good reputation. Now, another company or another study platform want to use the name MSS to start their own online class or physical session, whichever. So now, for my own side, you know, this goodwill that I'm trying to establish now, this reputation I'm trying to establish now, it is internally generated because I can't able to separate the cost for the overall cost of running the business. But now, if I want to, in 5 years' time, if I'm going to sell the brand name, I'm not talking about selling the idea, but the brand name. In other words, I'm going to give someone else the right to use MSS mentorship as part of the session he or she is going to provide. So if I'm going to sell the brand name of MSS mentorship to that particular individual, that individual will recognize the intangible assets in their own financial statement because it is purchased intangible assets on their own. But for me, I am not going to account for that goodwill I'm developing now or the brand name MSS because it is internally generated. It is not purchased goodwill. So this is a distinction. For internally generated intangible assets, we are not going to capitalize it. Another example, the family that started the idea of Coca-Cola, the recipe of Coca-Cola, when they are going to prepare their financial statement, they are not going to recognize an intangible asset because it is internally generated. While anyone else that wants to use the brand name of Coca-Cola that is going to pay to have the access to use the brand name of Coca-Cola, that individual is going to account for it as intangible asset because for the individual, it is purchased intangible asset. While for the family of Coca-Cola, the recipe, it is internally generated. They are not going to account for it as intangible asset. They are not going to capitalize it as part of the cost of the asset. Are we together? So now why are we not going to
Yeah.
why are we not going to capitalize internally generated? The reason is that the cost of the asset cannot be identified separately from the overall cost of running the business. Now, for example, as I'm currently working on the brand name of MSS Mentorship, it will be very difficult for me to separate the cost of the brand name, in other words, the mentorship I'm doing, the reputation I'm trying to build, the goodwill I'm trying to working on. It is difficult for me to separate this cost, and also it is difficult for me to separate the cost of running the business. For example, the cost of buying my ring light, the megaphone, the time I'm spending, the top-up I'm using to connect internet, whichever associated cost. The online platform I'm using, the payment I'm doing, the software I'm using, all of this cost. It is difficult for the brand name, the customer loyalty, the good reputation that I'm working on. It is very difficult for me to separate this cost from the rest of the cost of running the business. So because of the inseparability of the cost of the intangible assets, so that we cannot capitalize that particular intangible asset because it is internally generated. And also it is difficult for us to separate the goodwill, the brand name I'm trying to develop with other associated tangible costs of running the business. So because of this reason, we are not going to capitalize the intangible, internally generated intangible assets. So any internally generated intangible asset, we can't capitalize it. Goodwill, inherent goodwill, we are not going to capitalize the brand name, published title, whichever. Hence, it is internally generated. We are not going to capitalize it. Are we together? So now for goodwill, we are going to look
Yes.
at we are going to look at goodwill in detail when we are going to cover consolidation. After we have completed the ratio, we are going to focus on console. We are going to look at goodwill in detail under consolidation. But basically, what you need to know for intangible assets for goodwill, when we are talking about goodwill, goodwill is the difference or the amount that we are going, the extra amount that we are going to pay to secure a good reputation, an existing business reputation. The amount that we are going to pay is what we refer to as a goodwill. Now, for example, you want to use Manchester United name. If you want to use Manchester United name, Manchester United has already established a goodwill based on the previous history and based on the current history as well. So if you want to use the Manchester United, by default you need to pay a fee of goodwill, which is the amount above the net value, the fair value of the asset. The amount that you are going to pay above the fair value of the asset is what we refer to as a goodwill. Another example, in 5 years' time, if someone wants to use MSS mentorship, the amount the person is going to pay above the fair value of the asset, the net value of the asset, is a goodwill. So you can read through it, nothing to worry about. And what you need to know is how you can account for a goodwill. If the purchase consideration is more than the fair value of the asset, then we are going to account for it as increase in the value, which is a goodwill. And also, if it's a loss, then we need to look at how we can account for it as a bargain purchase. So now, let's look at purchase goodwill. For purchase goodwill, we are going to account for it in the financial statement. And when you're talking about purchase goodwill, in a business combination, if a parent company acquired a subsidiary, we are going to account for the goodwill. The goodwill arises on the consolidation of a subsidiary. We are going to look at it separately. Don't worry about it. And in most cases for IAS 38, it is not tested under IAS 38. Instead, it is frequently tested under um, consolidation, IFRS 10. For non-purchase goodwill, inherent goodwill, we are not going to account for it because it is internally generated goodwill. We are not going to account for it. Any internally generated intangible asset, we are not going to account for it. So this is the standard for goodwill, the business combination. Don't worry about it. You can read it on your own. You will understand how to account for the goodwill and also how to account for what to do for the non-purchase goodwill. So basically, the most important area for the intangible assets is the research and development cost, which is very much important for the examination. So now we need to know how to account for the research and development cost. How we can account for research and development cost. When we are talking about research, it's basically an original plan or an investigation process that we want to achieve. We want to gain a new business idea. We want to explore a new business opportunity. That process that we are going to do, the research that we are going to do, that cost, we are going to expense it. We are not going to capitalize it. We are not going to include it as part of the cost of the asset. Why? Because for us to include a cost as part of the cost of the asset, it should meet the definition as per the conceptual framework. It should result to a present economic benefit as a result of past events, you know, um, as a result of past events. So now this definition should be met. Very important. If the research cost, why are we not going to capitalize the research cost? It is because it is possible that throughout the research phase, the product or the research that we are going to do might not be successful. So we are not going to capitalize the research cost. But now the development cost, we are going to capitalize that development cost because the development cost is telling us that we need to transform from the research process, our finding from the research, our scientific knowledge, we need to transform it into a plan, into a design, which we can use to improve our production or to improve our device, to improve in anything that we did the research on. So if that is the case, the development cost, we should capitalize it. So research cost, we are going to expense it. Development cost, we are going to capitalize it. This is the concept that you need to know. For research, we are going to expense it. For development cost, we are going to capitalize it. However, the development cost, we have further conditions that will distinguish between the development cost and the research cost. Before we are going to capitalize a development cost, all of these condition, all of these conditions should be met before we are going to capitalize a development cost. First condition, look at the acronym pi rate. You need to know the pi rate. P is for the probable flow of economic benefit from the asset. It means that development cost, the research that we are going to put in application to development cost, that development process should bring a potential economic benefit from that particular asset. First condition. Now, when we are talking about the probability of the potential economic benefit, there should be, for example, in the examination, the question might tell you that based on the development phase, the market has accepted X, Y, and Z condition from the development phase. That is a good indicator that that particular development process can bring economic benefits from the business. Second condition, the I, intention to complete the intangible assets and use or sell. Now, the company should have the intention to complete the intangible assets. In other words, for example, the question might tell you during the forecast meeting or during the management meeting, the company is showing commitment to complete this particular intangible asset, or based on the budget or based on the forecast, you know, there is a lot of preparation in terms of how to complete the intangible assets. So that intention to complete should be there. From the question, there will be an indicator that will pinpoint the intention, that will show the intention to complete this intangible asset. Third condition, reliable measure of development cost. The cost associated within the development process should be measured reliably. Fourth condition, adequate resource to complete the project. There should be enough cash flow to complete the project. There should be a solid budget in place to complete the project. So basically, if the question mentioned about there's a lot of cash flow to complete the project, or there's a constraint in terms of cash flow to complete the project, this is an indicator that this condition is not met. So therefore, we are not going to capitalize that particular development cost as part of the cost of the asset. Technical feasibility, the T, of completing the intangible asset. It means we should have the technical know-how. We should have the people with the experience to complete that particular intangible asset, to complete the development process. For example, if we are talking about developing a chemical project, it means we need to have, the scientists, we need to have the people with the right experience to complete that particular project. Or if we want to develop, an accounting app or software, we need to have the technical people who will command the app to do the debit and credit, instruct the app based on the accounting standard. Those are the things that you should consider. So now from the question will tell you that the company has a solid accountant, which is part of the team to develop the accounting software, for example, or the company have a solid scientist. Just an example, the question will pinpoint a condition that will tell you that these conditions are met, or the question can tell you that during the development phase, the scientist or the accountant has resigned. So if that is the case, it means the technical feasibility condition is at risk in this particular situation. So we are not going to account for that development cost as capital. We are not going to capitalize that development cost. Final condition, expected to be profitable. In other words, based on the life of the project, based on the life of development cost, the company should expect that particular process to be a profitable process, which is very much important for the examination. Also, the question can pinpoint it that looking at the current economic trend, the development, the installation of this new project or the development of X, Y, and Z will be profitable or will increase the profitability. So therefore, this condition is met, or will not increase the profitability. So basically, if we are going to capitalize any development expenditure, if we are going to include any development expenditure as intangible assets, all of these conditions, all should be met. In the examination, the condition one or two can be given in the exam, which is fine. You don't need to worry. You are going to assess based on the information that is given to you. If the intention to complete is given, is mentioned in the question, then we are going to use the intention to complete as a basis to conclude our decision. The condition that is not mentioned in the examination, you don't need to worry about it. You don't need to find way about it. Just ignore it. We are going to assume that those conditions are met. But for the one that is mentioned in the question, we need to use it as a basis to determine whether the conditions are met or not. So basically, for intangible assets, that is what you need to know for intangible assets. Nothing else and nothing difficult about intangible assets. You need to know the definition of intangible assets. You need to know when to capitalize research and development costs and how to account for um, the purchase intangible from the internally generated intangible assets. So basically, let's browse through these kit question. Let's just browse through the question. And what I want to suggest again, at the end of the session, I would like us to start discussing the kit questions on the WhatsApp group because we need time to explain everything and we need time to understand. So let's look at example one. I don't know if these are the kit questions. Okay. Are we together?
Yes, sir.
Very good. So let's browse through a few of them questions. Which of the following cannot be recognized as intangible assets, as intangible non-current assets in GHK consolidated financial statements? Which of the following cannot be accounted for? A. GHK spent 132,000 developing a new type of product in June 20X1. Management worry that it will be too expensive to fund. Look at the condition. Oh. Which of the following cannot be recognized as intangible assets? Cannot be recognized. The finance to complete the project came from cash injection from a benefactor received in November 20X4. Okay. GHK purchased a subsidiary during the year. During the fair, during the fair value exercise, it was found that the subsidiary had a brand name with an estimated value of 50,000, but had not been recognized by the subsidiary as it was initially internally generated. Fine. GHK purchased a brand name from competitor on 1st November 20th. Fine. G spent 21,000 during the year on development of a new product after management concluded it will be viable in November 20th. The product is being launched on the market on 1st December 20th and is expected to be profitable. So we are going to look out for the odd answer. Which of the following cannot be recognized? Point D, GH spent 21,000 during the year on development of a new product after management have concluded it will be viable in November, which is fine. The product is being launched on the market on 1st December 2021 and expected to be profitable. So based on the development cost criteria, the final criteria is the expectation for the profitability, and it is mentioned in this question. So D is correct. It will not be part of the option that we are going to select for this particular answer. C, GHK. Are we together? GHK
Yes, sir.
purchased,
Yes, sir.
okay. GHK purchased a brand name from a competitor on 1st November 20X1. This is purchase intangible assets. And based on the concept, we should capitalize purchase intangible assets. We should include it as part of the cost of the assets. Are we together?
Yes, sir.
It's clear. B, GHK purchased a subsidiary a subsidiary during the fair value exercise, it was found that the subsidiary had a brand name with an estimated value of 50,000, but had not been recognized in the subsidiary by the subsidiary as it was internally generated. It's fine. For the subsidiary, the goodwill, the brand name is internally generated for the subsidiary, but for the consolidated group, and the question is talking about GHK consolidated statement of financial position, not for the subsidiary. So for the consolidated financial statement, we need to include this as part of the goodwill. It should be included as intangible assets because we are not going to account for the subsidiary, but instead we are going to account for both GHK and the subsidiary as a single entity. So the odd answer in this question is A. Why A is wrong? Because GHK spent 132,000 developing a new product, a new type of product. In June 2021, management worried that it will be too expensive, and based on the condition, there should be fund to complete the development expenditure before we are going to capitalize it. Are we together? Look at the condition up. Look
Yes,
at the
sir.
condition.
Yes, sir.
Let's go through the condition once more. Intention to complete and adequate resources to complete the project. Intention to complete and adequate resources to complete the project. Now, management worried that it will be too expensive to fund. So there is doubt as to whether they are going to continue the development of this particular project. The finances to complete the project came from cash injection from a benefactor received in November. Wow. We don't care about the source of the fund. We need to know whether management is willing to complete the project. Management has the intention to complete the project. Management, has the technical feasibility to complete the project. Now, because of the management is worried that the project is too expensive, we are not going to include it. The particular question did not meet the recognition criteria, the condition for development cost to be capitalized. So A is the correct answer. Which of the following cannot be recognized as intangible asset? So understanding your concept, understanding your principle will help you to solve question in the examination. All of the options is based on the application of your knowledge of what I've explained a few minutes ago. So you need to focus on understanding your concept and you need to spend more attention. Which of the following could be classified as development expenditure in M statement of financial position as at 31st March 20XY according to IAS 38? Which of the following could be classified as development cost? A. 120,000 spent on developing a prototype and testing a new type of propulsion system. The project needs further work on it as the system is currently not viable. And one of the conditions for us to capitalize the development cost, it should be profitable. There should be an indication of profitability. So now if the question is telling us that the project needs further work on it as the system is not currently viable, so we can't determine the profitability level based on this particular statement. So we are going to look for another alternative. We are going to question A for now. We are going to look for a better alternative. A payment of 50,000 to local university engineer faculty to research new environmental friendly building technique. This is research cost. So B is X. We don't have anything to do with B. We are going to expense it because this is pure research. C, 35,000 developing electric bicycle. This is near completion and the product will be launched soon. As this project is first of its kind, it is expected to make a loss. Wow. The expectation is to make a loss. And based on the condition for development cost to be capitalized, there should be an expectation to make a profit, not a loss. Look at the question. This is near completion and the product will be launched soon. Although the product will be launched soon, yet the expectation is to make loss. So C is out of the equation. We don't have anything to do with C. It's against the condition. D, 65,000 developing a special type of new packaging for a new energy efficient light bulb. The packaging is expected to reduce distribution costs. It's expected to reduce distribution costs. So it means the packaging can can help the business to reduce distribution costs, which will enhance the economic benefit. So in other words, a cost reduction is an expectation to make profit. Are we together? It's a benefit that this particular development phase will provide to the company. So D is the correct answer. Why D is the correct answer? Because the package is expected to reduce distribution cost. A reduction in cost is a favorable strategy for the business. It's an expectation to make profit because if the cost is reduced, the company will make profit by default. The company will make profit because the cost has reduced. So hope you can see the technicality in the questions. So you need to focus on understanding your concept. Failing to understand the concept, you will lose easy mark in the examination. Example 4. Which two of the following factors are reasons why key staff cannot be capitalized as intangible assets? Why key staff? Why are we not going to capitalize staff, employee as intangible assets? Why are we not going to capitalize employees as intangible assets? We need two conditions. They do not provide. Now, look at the definition of intangible assets and look at the recognition criteria. Therefore, we are going to understand why are we not going to capitalize the key staff. A, they do not provide expected future economic benefit. Do employee provide a future economic benefit? Yes. B, they cannot be controlled by an entity. C, their value cannot be measured reliably. D, they are not separable from the business as a whole. Which two of the following factors are reason why are we not going to capitalize an intangible? Why are we not going to capitalize? The two reasons that will stop us from capitalizing staff as part of intangible assets. Who can tell me from this particular question? Hello?
See, the value cannot be measured reliably.
And what? C and what?
C and B, they cannot be controlled by an entity.
Any other option minus C and D? C and B, eh? Check no, it says C and B.
Yes, sir. C and B.
Any other option? The ladies. What are Jennifer?
I also go with B and C because obviously they provide future economic benefits, and I think they're separate.
So what about D?
And they're separately from the business. So I think B and C for me also.
So any other alternative minus B and C?
Um, for me, B and D.
Okay. Any other
B
alternative?
and D for me.
Okay. So basically, the correct answer are B and C. D, they are not separable from the business. Now, Fatmata, you are working, right? You and the
Yeah.
business, and also based on the business entity concept, the business and the owner should be treated as a separate legal entity. What about if the business and its owner should be treated as a separate legal entity? What about you, the employee? You are separable from the business. You can leave at any point in time you want without any question. You just need to forfeit your 1 month salary in lieu of notice. Nothing else will cost you more than that.
Sometimes the company they bond you with something. Like for example, like if they pay something for you or they make you travel, you go on training, they use certain years we for take we for work before you even consider for resign. Or for example back, if I dey do this message so I done them, they refund me all the money. Then go like give you time for even think for resign.
So now you have the option to resign, right? So you have the option, regardless of the conditions that are attached, whether you decided to travel, for example, no, most of the banking industry they usually do that. They take you to Ghana, whichever part, then on 2 years' time, you should not leave the bank. Now the concept is telling us that when we are talking about separability from the business, it means we are not going to look at you, the employee, as the business as one. So regardless of the attachment, at any point in time you want to leave, you can leave. Even with that particular condition, you can leave. So the best alternative option from this scenario, B and C are correct because they cannot be controlled by an entity, the value cannot be measured reliably. So now,
Okay.
any other question? So 5, 6, and 7, you are going to look at it so that we can 9:23. I want us to do IAS 23. I don't know. Will I leave it for Thursday or let's continue? But
Let's continue.
we still have
Yeah, we still have free
six
time.
we still have 6 plus
5,
15.
10, 15, 20 minutes more.
Yeah, we still have 20 minutes. So we can continue because IAS 23 is not difficult. You can browse through it. So basically now we are talking about IAS 23 borrowing cost. Now what you need to know for borrowing cost, nothing difficult about borrowing cost. When we are talking about borrowing cost, now for example, if a company want to develop a company want to build a five-story building that will take 5 years to build, right? But due to cash flow management, due to constraint in finance, the company did not have the capital to build the five-story building. So now what the company will do, the company will secure loan, will secure finance from whichever institution. So that finance that the company is going to secure for that particular project, the interest that we are going to pay on that finance, the interest element only that we are going to pay on that finance, we should capitalize it as part of the cost of the assets. This is exactly what the borrowing cost is telling us. The interest that we are going to pay on a qualifying asset, we are going to look at the condition for us to classify an asset as qualifying or not. If we are going to pay interest on qualifying assets, that interest will be capitalized. Only on qualifying assets. Any other thing other than qualifying assets should not be capitalized. We are going to expense it as normal interest expenses in the statement of profit or loss. So now that's the key concept. So now what you need to know, we need to know the definition of a qualifying asset. When we are talking about a qualifying asset, it means assets that can take substantial or significant period of time to complete. Normally, based on IAS 23, assets that can take greater than 12 months or 1 year to complete, that asset is considered to be a significant period of time to complete. So any asset within or less than 1 year, we can't consider it to be a qualifying asset. So the interest that we are going to take to finance any expenditure, any asset which is less than 1 year, we are not going to capitalize that particular interest. Instead, we are going to expense it. But if the expenditure is on a qualifying asset, assets that can take substantial period of time to complete, that interest that we are going to pay on the borrowing cost should be capitalized should be included as part of the cost of the asset. So this is the concept that you need to know, and this is the concept that you need to have back of your mind. Alternatively, we have basically it's a definition. You can look through it, nothing difficult about it. And we have conditions that you need to be aware of. And these conditions are very much important. Whenever we are talking about conditions per any accounting standard, it is very much important to pay attention on this condition because these conditions will be tested in the examination. So now we need to know when are we going to start capitalization and when are we going to stop capitalization. It's very important for us to know because we are not just going to capitalize or we are not going to start capitalization at any point in time. No. For example, we want to construct a five-story building that will take 5 years. We decided to take the loan early so that we can start paying interest now, so that we can start capitalizing increase in the interest now, so that we can increase the asset value now, which is not the correct system to start capitalization. So basically, we want to limit the idea that the accountants should use, the accounting standard to do window dressing. That's why we need to look at the condition of capitalization. IAS 23 states that capitalization of borrowing costs should commence when all of the following conditions are met. All of the following. First, expenditure for the asset is being incurred, which is very clear. Now, for example, if we want to construct a five-story building, we should start to incur expenditure on that particular building. We should start looking out for supplier, start to do some legal expenditure, for example, to prepare the land, to do some sustainability checkup, to do some arrangements with the community. Those expenditure should have been incurred because we want to see the commitment that the business want to develop this particular project. It is not a mere amount or a discussion from meeting or whichever the situation might be. We need to see an action that will indicate that the amount that is that is secure to finance the project is actually been used in the preparation of X, Y, and Z. So that expenditure should have been incurred in connection with this particular asset that we are going to construct. Second condition, the borrowing cost has been incurred. The amount that we are going to take should be incurred in X, Y, and Z. For example, we're going to use the cost, the 10 million to buy cement, to buy iron rod, to pay the workers. We need to incur that particular borrowing cost. Finally, activities that are necessary to prepare the asset for its intended use or sale are in progress. So we need to look for active markets. For example, if we are going to develop a project, we need to look for active markets to ensure we have the technical feasibility, we have the market available to sell that particular product. So these conditions should be met before we are going to start the capitalization of the borrowing cost. Other than that, we are not going to start capitalization. And if we are not going to start capitalization, it means all of those periods we are going to expense it. For example, we took out a loan on 1st January 20x5. Now, until the end of June 20x5, these conditions are not met. So we are going to expense all of the 6 month borrowing cost. Then let's assume in July, these conditions are met, then we are going to start the capitalization from July. We are not going to capitalize backward. We are going to start from July to the time we need to stop capitalization. So it's very much important. Not all borrowing costs should be capitalized, only the costs that met the definition, that met the condition as per IAS 23 should be capitalized. The rate of interest to be used, no need to worry for this examination, just need to read through it. The concept of interest rates, we are going to look at it under the financial management, how to calculate the debt and equity, don't worry about it. So basically, we have two types of borrowing. We have specific borrowing and we have general borrowing. Now, for specific borrowing, it means if we took out a loan to finance a specific asset, to acquire a specific asset, or to construct a specific qualifying asset, we are going to use the specific borrowing. For example, we took out a loan to build a five-story building just for the building. We took out a loan to finance a project just for that particular project. So that particular cost is what we refer to as a specific, single, specific borrowing. The loan that we took out is for a specific purpose, not for general purpose. So that particular borrowing is what we refer to as a specific borrowing. So for the specific borrowing, it's very simple. So now, what cost are we going to capitalize, which is very much important? We are going to capitalize the the borrowing cost less any temporal investment income. Very important point again you need to know for the examination. So now when we are talking about potential temporal investment income, for example, in real life, if I want to develop a product or I want to build a five-story building, I decided to take out a loan on the start of the project. But due to one or two reasons, I want to invest the money, the loan I decided to take out, I want to invest that particular money. So if that is the case, if I decided to invest portion of the borrowing amount, the borrowing fund, that amount I'm going to invest, the interest I'm going to receive from that investment, that income that we are going to receive from that investment should be net off from the overall borrowing cost. So the net value is what we are going to capitalize. Don't worry. Let's look at this example so we can able to understand better. A company takes a bank loan of 2 million at 10% specifically to construct a new factory, right? So basically, the interest for the year is 2 million multiplied by 10%. This is the interest that we are going to pay. Now, temporal investment income is 20,000. The borrowing cost to be capitalized is this. So we are going to capitalize 180,000 because the investment income should be deducted from the overall borrowing cost of 200,000. So let's assume this particular question, the company did not invest any of the borrowing cost, any of the borrowing fund. So it means the whole of the 200,000 should be capitalized. But if the company decided to invest to benefit from investment income, then we are going to capitalize 180 as borrowing cost. Now, that's for specific borrowing. For general borrowing, if we decided to secure a loan for general purpose, for example, to construct a building, to pay a salary, you know, to fund different X, Y, and Z projects, that particular borrowing, we can account for it as general borrowing. General borrowing is talking about when we decided to borrow money to finance multiple projects, multiple business operation. That is general, from the word general borrowing. So now what we are going to do with general borrowing is that we are going to use the weighted average cost of borrowing. This is the only technical bit. We need to calculate the weighted cost of borrowing. The weighted cost of borrowing is what we are going to use to apply on the borrowing fund. So it's very simple. For us to calculate the weighted, we need to calculate the total amount divided by the rate. You don't need to worry about it. Also, you can go through the recording session, detailed explanation on how to calculate the general borrowing is there. So you need to do your own part of the coin and you need to ensure you study hard. So basically, we are going to look at when to stop capitalization. Capitalization of borrowing cost should cease when either substantially all of the activity necessary to prepare the qualifying asset for its intended use or sale are complete. For example, the building has been completed, nothing much to do. We just need to paint, we just need to do some cleaning work. So if substantial activities are completed, so we need to stop capitalization. Also, if construction is suspended due to industrial dispute, for example, um, let's assume the current trend between America and Iran, right? We are constructing an asset. Due to this current trend, the construction process cannot go further because of the escalation. So this is industrial dispute. This is a global situation. So this period that we are not going to do the construction, this period that we are going to suspend the construction, we are not going to capitalize any borrowing cost for this particular period until the suspension is over. So we are going to start the capitalization, then we are going to stop the capitalization, and also after the suspension, we are going to continue back the capitalization. For suspension, we are going to continue back the capitalization. But the suspension should be for industrial dispute, for global situation, for a major economic event that can affect significant amounts of people. So these are the conditions that we are going to use to stop the capitalization of intangible assets, of the borrowing cost, right? So basically, for IAS 23, you need to know the definition of a qualifying asset, because you can only capitalize the borrowing costs on qualifying assets. And also you need to know the condition when to start capitalization and when to stop capitalization. And also you need to know the distinction between the specific borrowing and the general borrowing. So any question for IAS 23? Any question? Hello guys.
No question from me.
What about others?
No question, sir.
No question.
Once I call attendance list,